The silver market just did something we haven't seen in years. And if you're not paying attention right now, you're going to miss one of the biggest wealth transfer opportunities of this decade. While you were sleeping last night, silver prices gapped up dramatically on the futures market. And this isn't just another price fluctuation. This is the beginning of what many analysts are calling the Great Silver Squeeze, and the implications for your portfolio, for the global economy, and for everyday people like you and me are absolutely massive. In the next 5 minutes, I'm going to break down exactly what happened, why it matters, and most importantly, what you need to do right now to position yourself on the right side of this historic move. Let's start with what actually happened overnight. Silver futures opened significantly higher than where they closed the previous day, creating what traders call a gap up. Now, gaps in commodity markets are relatively rare, and they typically signal one thing: something fundamental has shifted. We're not talking about a gentle rise or a typical trading fluctuation. This was a violent move that caught short sellers completely off guard. The gap occurred during Asian trading hours when liquidity is typically lower, which actually amplifies the significance because it means the buying pressure was so intense that it overwhelmed the market even with fewer participants. When silver gaps up like this, it's telling us that buyers are willing to pay significantly more than the last traded price, and they're doing it aggressively. So why is this happening now? The answer lies in a perfect storm of factors that have been building for months, and in some cases, years. First, we need to talk about the supply situation. Silver mining production has been declining, and here's something most people don't realize. Roughly 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. When those mining operations slow down, silver supply gets squeezed automatically. Meanwhile, industrial demand for silver has been exploding. We're talking about solar panels, electric vehicles, electronics, and emerging technologies that all require significant amounts of silver. Unlike gold, which is primarily a monetary metal, silver is being consumed by industry. And once it's used in these applications, it's often gone forever because it's not economically viable to recover it. But here's where it gets really interesting. The financial demand side is heating up dramatically. Retail investors around the world have been steadily accumulating physical silver, taking delivery of coins and bars and removing them from the available supply. We saw this movement gain momentum back in early 2021, but it never really went away. It just went underground, with savvy investors quietly building positions while prices were relatively suppressed. Now, institutional money is starting to pay attention. When you see a gap up like we just witnessed, it's often a sign that bigger players, the hedge funds, the commodity trading advisors, the institutional desks, are rushing to enter positions or cover short exposure. Speaking of short positions, this is absolutely critical to understanding what's happening. The silver market has been one of the most heavily shorted commodity markets in the world. Banks and large institutions have held massive short positions, essentially betting that silver prices would stay low or decline. These short positions have acted like a coiled spring, and when prices start moving against the shorts, they're forced to buy silver to cover their positions, which pushes prices even higher, which forces more short covering, creating what's known as a short squeeze. This is exactly what appears to be happening right now. The gap up we saw is consistent with panicked short covering, where traders who are betting against silver are scrambling to exit their positions before losses spiral out of control. Let's also talk about the monetary backdrop that makes this silver move even more significant. Central banks around the world have printed unprecedented amounts of currency over the past several years. While inflation has cooled from its peak, the underlying concerns about currency debasement haven't gone away. Precious metals, and particularly silver because it's more affordable for average investors, become increasingly attractive as a store of value when people lose confidence in paper currencies. We're also seeing geopolitical tensions remain elevated, with ongoing conflicts and trade disputes creating uncertainty. In uncertain times, hard assets like silver tend to shine, quite literally. Now here's something that should really get your attention. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of modern history, this ratio has averaged somewhere around 50-1. In recent years, it's been much higher, meaning silver has been dramatically undervalued relative to gold. When silver starts catching up, and a gap up like we just saw suggests this is beginning, the percentage moves in silver can be absolutely explosive. We're talking about the potential for silver to double or even triple from current levels if it simply returns to a more normal relationship with gold. What does this mean for you practically? If you don't own any physical silver yet, this gap up is both a warning sign and an opportunity. Yes, prices are higher than they were yesterday, but if this squeeze continues to play out, we could be in the very early innings. Consider allocating a portion of your portfolio to physical silver. whether that's coins, bars, or rounds from reputable dealers. If you already own silver, this is validation that your patience is paying off, but don't get too comfortable. In a squeeze scenario, prices can be extremely volatile. We could see sharp pullbacks even within an overall uptrend, so emotional discipline is crucial. For those interested in leveraged exposure, silver mining stocks and ETFs can provide amplified returns, but they also come with amplified risk. The miners have been beaten down for years, and they're highly leveraged to the underlying metal price. A 20% move in silver could translate to a 50 or even 100% move in a well-positioned mining stock. But be warned, this is not for the faint of heart, and you need to do your homework on which companies have strong balance sheets and quality assets. The bottom line is this: the silver market just sent us a signal that cannot be ignored. The gap up we witnessed is the kind of technical event that often marks the beginning of major moves, not the end. With supply constraints, surging industrial demand, potential short covering, and a monetary environment that favors hard assets, silver is setting up for what could be the move of the decade. The squeeze is on, and the question isn't whether silver is going higher, it's whether you're going to be positioned to benefit when it does. Stay informed, stay disciplined, and most importantly, take action. This is your moment to make a decision that could impact your financial future for years to come. Claude is AI and can make mistakes. Please double-check responses. Sonnet 4.5.